Welcome back to the Deep Dive. It is Thursday, January 22, 2026.
And the market is definitely buzzing.
It is. If you have been glued to the financial tickers over the last, 24 hours, you have likely seen a lot of green next to a name that, let's be honest, usually it puts people to sleep.
It is not often that a midstream pipeline company dominates the headlines, is it?
Exactly. Usually if they are in the news, it's because something broke.
Right.
But we are talking about Kinder Morgan today. They released their Q4 2025 earnings report after the bell yesterday, and the market reaction has been surprisingly intense. The stock's hovering around, $29.86.
Yeah, and trading volumes are way up. The whole narrative around the company just feels like it shifted overnight.
It really has. And that's our mission for this deep dive. We've got the full stack here, the earnings call transcript, the press release, all the financial tables.
And the analyst notes.
And we are going to parse through all of it to answer one core question. How does a company known for, rusty pipes and slow, boring dividends suddenly find itself at the center of the AI revolution?
It sounds like hyperbole, doesn't it? Pipelines are the new AI trade.
It does.
But when you look at the data we have here, specifically around power demand and data centers, it's the most logical conclusion.
Okay, so before we get to all the AI excitement, let's just ground ourselves with the high-level summary. Kinder Morgan just posted a record-breaking year. They beat their budget, they beat Wall Street expectations, and they raised the dividend.
It was what we'd call a clean sweep quarter. A lot of times you see a company beat on earnings, but then they miss on revenue, or maybe they beat, but then they lower guidance.
Right.
This was just strong across the board.
So let's get into the hard numbers, because that's where the story starts. They reported yesterday, January 21st. What jumped out at you first when you opened up the spreadsheet?
The immediate standout was the bottom line. Adjusted earnings per share EPS came in at 39 cents.
Okay.
Now, the consensus estimate from, all the major banks was sitting at 37 cents.
All right, I have to play the cynic for a second here. A 2-cent beat. To anyone not in this world, 2 cents sounds like a rounding error. Why does that matter so much?
Yeah, it's a totally fair question. Context is everything here. In the tech world, a 2-cent beat is nothing.
Right.
But you have to remember, we are talking about the utility and midstream sector. These businesses are modeled out to the decimal point. They are supposed to be predictable, boring cash machines.
So in a world of boring predictability, a 5% surprise is actually a shock.
Exactly. It tells you the models were wrong because the business is performing way better than the status quo.
And the revenue numbers back that up too.
They did. $4.51 billion in revenue versus an expectation of $4.33 billion. That is a $178 million surprise in one quarter. Right. And if you look at the year-over-year growth, that is where the story gets really exciting. Adjusted EBITDA for the fourth quarter was up 10% compared to last year.
I want to pause on that acronym EBITDA. We hear it all the time on financial news. For the listener who isn't a CPA, why is that the metric we care about here? Why not just look at net income?
Great question. It stands for earnings before interest, taxes, depreciation, and amortization. Basically, it's the purest measure of the cash flow that the actual business operations generate.
So it ignores the accounting stuff.
It ignores the accounting tricks, the tax strategies. For a company like Kinder Morgan, which owns billions of dollars of heavy infrastructure, depreciation makes their net income look way lower than it really is.
Because they have to write down the value of the pipes on paper every year.
Precisely. But that write-down isn't actual cash leaving their bank account. EBITDA tells us how much cash the pipes are actually spitting out right now. And seeing that grow by 10%, that's significant.
And that cash machine is accelerating. Adjusted EPS was up 22% for the quarter. I mean, that feels incredibly high for a mature business.
It is. You're usually hoping for, 3% or 4% growth in this sector. 22% implies they're squeezing significantly more value out of their existing assets. They are not just maintaining, they're scaling.
And importantly, they're not doing this by just racking up the credit card. The balance sheet looks cleaner than it has in years.
That was the sleeper hit of the report for me. Their net debt to adjusted EBITDA ratio.
Which is basically how many years of income it would take to pay off their debt.
Right. It's down to 3.8 times.
Is 3.8 actually good? What's the benchmark?
For this industry, it's stellar. A few years ago, anything under 4.5 was considered safe. Getting under 4.0 puts them in a very, very elite tier of safety. It just means they aren't over-leveraged.
And the credit agencies agree with you. S&P upgraded them to BBB+ just last week on January 13th.
And that upgrade is real money in their pocket. A better credit rating means they get lower interest rates on their debt. So they borrow cheaper, which improves margins even more. It's a virtuous cycle.
And of course, they are passing that cash to shareholders. A cash dividend of what? Roughly dear 29 cents per share, up 2%?
Yep. It's the classic, get paid to wait, you get the steady income of a utility, but now all of a sudden you have this growth engine attached to it.
Okay, let's pivot to that growth engine. Because if you just look at the financials we just discussed, you see a really healthy pipeline company. But if you read the transcript of the call with CEO Kim Dang, you see a technology infrastructure company.
That is the aha moment of this quarter, right there.
We keep hearing about the power demands of artificial intelligence. You know, ChatGPT, DeepSeek, Gemini, they all need these massive server farms. But Kim Dang put a specific number on what that actually means for Kinder Morgan.
She did. She revealed that 60% of their $10 billion project backlog is associated with power projects.
60%. So the majority of the new stuff they are building isn't for heating homes or fueling cars, it's for generating electricity.
Correct. And this is a fundamental shift in the whole narrative. For years, the story was, crude oil is dying, gas is a bridge fuel. Now, the story is we literally cannot run the internet without natural gas.
But why? I mean, we have solar, we have wind. Why are all the data centers turning to gas?
It just comes down to physics and reliability. A hyperscale data center, the kind Microsoft or Google or Amazon builds, needs what's called 5 nines of reliability, 99.999% uptime.
And the sun doesn't shine 99.999% of the time?
Exactly. Renewables are intermittent. If a cloud blows over a solar farm, the voltage drops. You just cannot have that when you're training a trillion-parameter AI model. The entire process could crash. So they need baseload power.
Okay.
Nuclear takes a decade to build. Coal is, well, environmentally a non-starter for these companies. Natural gas is the only scalable, dispatchable solution that's ready to go right now.
There was a stat about Georgia Power in the transcript that frankly just blew my mind.
I know exactly the one you mean. Georgia Power projects, they need 53 gigawatts of power demand growth through the early 2030s.
53 gigawatts. Can we just put that in perspective? How much power is that really?
To put in perspective, 1 gigawatt can power roughly 750,000 homes.
Okay.
So 53 gigawatts is enough to power roughly 40 million homes. That is the entire power demand of a large European country just being added to the grid in the state of Georgia.
That is staggering. So what's Kinder Morgan's role in that?
Well, if you tried to meet just that specific demand with natural gas, it would require about 10 billion cubic feet or BCF per day of gas.
Wow.
No, obviously it won't be all gas, it'll be a mix. But even if gas captures, say, 30 or 40% of that, it represents a tidal wave of new volume moving through pipelines.
And you can't just build a data center in the middle of nowhere. You need the infrastructure already in place.
That is the moat that Kinder Morgan has. CEO Kim Dang pointed out that approximately 70% of the future data center capacity that's currently under development, it's located in states already served by Kinder Morgan.
So the tech companies are basically coming to them, hat in hand.
They have to. Kinder Morgan is the landlord of the energy corridor. If you want to build a server farm in Texas or the Southeast, you are likely parking it right on top of a KMI pipeline. That provides immense operating leverage.
Explain that term for us, operating leverage.
It means they don't always have to dig a trench and lay a brand new pipe across the country, which is super expensive and politically difficult.
Right.
A lot of the time, they can just add compression to existing lines to speed up the gas flow, or maybe build short lateral pipes to connect the main line to the data center. The cost is low, but the revenue is high. That is pure profit margin.
So that is the domestic story. The AI brain needs food, and that food is natural gas. But there is a second pillar to this whole bull case, and that's international. The LNG boom.
Yeah, and Executive Chairman Rich Kinder, who is, usually a very understated, realistic guy, he was incredibly bullish on this. He called the outlook grounded in reality, but also very strong.
They talked about feed gas demand hitting 19.8 BCF per day in 2026.
And feed gas is just the natural gas you feed into a liquefaction terminal to turn it into liquid for export. A 19% jump in that demand in a single year it's almost unheard of. That is a massive step change.
And looking out to 2030, they see it hitting 34 BCF per day. What's driving that global hunger for it?
It's really a geopolitical reshuffling. Europe has structurally moved away from Russian gas. Asia is trying to move away from coal to clean up its air quality.
And the U.S. has the gas.
The United States has the cheapest, most abundant gas in the world. We are becoming the gas station for the planet.
And Kinder Morgan is the pump.
They currently move 40% of all natural gas that's destined for LNG exports. Just think about that market share. Almost half of the gas leaving U.S. shores touches a Kinder Morgan asset.
Now, I have to play the skeptic again. We're talking about commodities here. They're volatile. We've all seen natural gas prices crash before. So if the price of gas drops to $2, or if Europe has a warm winter and stops buying, doesn't Kinder Morgan get hurt?
This is probably the single most common misconception about midstream companies. People think they're betting on the price of the commodity. They are not. They are betting on the volume.
But if demand drops, volume drops, right?
Not necessarily, and that's because of the contract structure. They use what are called take-or-pay contracts.
Break that down for us. How does it work in practice?
Think of it like renting an apartment. You sign a lease for a year.
Okay.
Whether you sleep in that apartment every single night or you go on vacation for a month, you still have to pay the rent.
The landlord gets paid no matter what.
Exactly. Kinder Morgan signs these long-term contracts, we're talking 15, 20 years, with massive utilities or foreign governments. Those customers reserve the space in the pipe. Even if they don't ship a single molecule of gas because prices are low, KMI still collects the check for the reservation.
That creates an incredible safety net.
It turns a volatile commodity business into a stable annuity business. They have successfully offloaded all of that price risk onto the customer.
Okay, let's talk about execution. It's one thing to have all this demand. It's another thing to actually build the infrastructure. Their backlog is up to $10 billion now. What are the marquee projects we should be watching?
The headliner is definitely the Trident project. Construction has officially started. This is a $1.8 billion monster connecting the Katy hub in Texas down to Port Arthur.
Port Arthur being a major LNG export terminal.
Correct. But there's a really nuanced regulatory win here that we need to highlight because it changes the timeline for everything. It's about the 871 rule.
I saw this in the transcript. It sounded like bureaucratic jargon, but you could tell management was thrilled about it.
Yeah.
What exactly changed?
Oh, it's huge. In the past, under Rule 871, even after the government approved your pipeline, you had this mandatory waiting period, often 5 months or more, where you just couldn't touch the ground.
So you're just burning cash while you wait.
Exactly. You've got crews on standby, capital is all tied up, and you're making zero progress. That rule is gone.
Gone completely.
Completely removed. And you combine that with a more efficient FERC, that's the Federal Energy Regulatory Commission, which is now acting on applications within 12 months, and the whole speed of business has just changed.
So what does that mean for a project like MSX, the Mississippi Crossing project?
It means the timeline shifts left. Instead of coming online in, say, late 2028, it potentially comes online in the second quarter of 2028. That's 6 months of extra revenue, 6 months of a faster return on your investment. In a capital-intensive business, time is literally money.
They're also expanding in Florida too, right?
Yes, the Florida gas transmission. They announced 2 new projects there. This isn't about AI or exports. This is about resiliency. South Florida is growing, and with climate volatility, they need to ensure the AC stays on. These are safe, utility-backed projects.
It seems like they have a finger in every pie. Even traditional product pipelines, gasoline and diesel, with that Western Gateway project.
That's a partnership with Phillips 66. It shows they aren't abandoning the legacy business, they're optimizing it. Connecting refineries to Phoenix and California is a really niche, high-value play because California has such unique fuel requirements.
Okay, we've been very positive so far. But a deep dive has to look at the risks. There was some noise in the report about the Bakken region.
This was the main bear case point that analysts were picking at.
Continental Resources, a major driller, announced they're stopping all drilling in the Bakken. I mean, if I own a pipeline in the Bakken, I'd be sweating. If the drillers leave, the pipes run dry.
And on the surface, it looks bad. But management came out with a very specific statistic to kill that fear.
Which was?
The Bakken only represents about 3% of their total EBITDA.
3%. So even if it goes to zero, which it won't, it's a scratch, not a mortal wound.
Precisely. And they aren't just sitting there letting the assets rot. They're pivoting. They announced they are taking the Double H pipeline out of crude service.
And just shutting it down.
No, converting it. They're switching it over to transport NGL's natural gas liquids.
What are NGLs used for? Why make that switch?
NGLs are things like ethane and propane. They're used for plastics, for petrochemicals, for heating. The economics for NGLs in that region are simply better than crude oil right now. It just shows agility. They're repurposing the steel in the ground to match the market reality.
What about the risk of overbuilding? We're building all these LNG terminals. What if the global economy slows down and we suddenly have a glut of gas?
That's a valid macro fear. But again, you have to look at the counterparty. Kinder Morgan isn't selling gas to some volatile startup. They're contracting with investment-grade utilities.
Yeah.
Even if the market gets flooded, KMI holds the toll booth. If the traffic slows down, the toll is already prepaid because of those reservation fees we discussed.
It really all comes back to that discipline, doesn't it? Which brings us to the final piece of the puzzle, capital allocation, how they actually spend their money.
They made a move this quarter that I think defines their philosophy perfectly. They sold the EagleHawk asset.
This is a pipeline in the back.
Yeah.
They sold a 25% stake for, what, $396 million?
Right. Now, a growth-obsessed CEO would never sell a cash-flowing asset. They want to build an empire. But KMI management, they ran the math. They got a price of 8.5 times EBITDA for it.
Is that a good price?
It is a very full price. They basically realized that the return they were getting on that asset was lower than their own cost of capital. So they sold it, took the $396 million, and used it to pay down debt or fund higher return projects like these new AI pipelines.
It's just buying low and selling high, effectively.
It is ruthlessly efficient, and it allows them to fund their $3 billion annual growth plan entirely with their own cash flow.
That is the holy grail part of this. They don't need to go to the bank.
They don't need to issue stock and dilute you. They don't need to borrow at 6 or 7%. They are self-funding. That makes them incredibly resilient to whatever the Federal Reserve decides to do with interest rates.
So let's bring it all together. We have a company that's trading at a pretty reasonable valuation, paying a growing dividend, it has a pristine balance sheet, and it's sitting right at the intersection of the two biggest demand trends in energy, AI data centers and global LNG.
It is the perfect storm of boring meets booming. They spent 10 years doing the really boring work of fixing the balance sheet, and now they are perfectly positioned to capture the booming demand of the AI era.
Before we sign off, I want to leave the listener with one thought that really stuck with me from CEO Kim Dang's comments on the call. We talked about the $10 billion backlog, the projects we know about, the ones with signed contracts.
But then she mentioned the shadow backlog.
She said they are currently pursuing another $10 billion in opportunities beyond what is official.
And that is the provocative thought to end on, isn't it? We can see the bulldozers for the current projects, but behind closed doors right now, utility CEOs and tech giants are negotiating another $10 billion worth of infrastructure.
It really makes you wonder, when we look at the cloud or when you talk to an AI chatbot, how much of that magic is actually physically reliant on a steel pipe buried 6 feet under the mud in Texas?
A lot more than people realize. The cloud is built on the ground.
The cloud is built on the ground.
Yeah.
I love that image. That wraps up our deep dive into Kinder Morgan's Q4. 2026 is shaping up to be a fascinating year for the energy sector.
It certainly is.
Thanks for listening. We will see you on the next deep dive.